The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
A very warm welcome to Squawk Box Europe. I'm Steve Sedgwick with Karen Cho, and these are your headlines. U.S Iran talks conclude in Switzerland for now, with an agreement to work towards a final deal within 60 days. But negotiations are hampered by the President of America's renewed threats, whilst Iran says it has closed off the Strait of Hormuz again.
Crude prices fall after Iran says it will resume oil and petrochemical exports, with the positivity reflected across in the Asian session, where the Nikkei hits another all-time high. UK Prime Minister Keir Starmer weighs his political future as more MPs call for him to quit. Reports suggest an announcement could come as soon as today.
The US and Iran have agreed on a roadmap towards a final deal in 60 days, including a mechanism to end military operations in Lebanon. Wonder how Israel feels about that. The developments emerged from talks in Switzerland on Sunday, according to mediators from Qatar and Pakistan. Speaking ahead of the talks, the US Vice President J.D. Vance framed them as an opportunity for a reset in relations, but warned a return to the old way is also a possibility.
The question before us now is how much more can we accomplish together? Can we turn over a new leaf? Can we change relations in the Middle East permanently? Or do we go back to doing things the old way, which is not our preference, but is certainly very much something that can't happen?
OK, well, let's get to Dan. Dan, what a confusing old weekend. 1 minute the president's saying it's shut again. Then the Iranians are saying we're selling our oil. You're the only person who can tell us actually what's going on.
Well, Steve, I think all of this ultimately shows that the negotiation process is still very much underway. Nevertheless, early this morning, the first round of direct US-Iran talks concluding with both sides agreeing on a roadmap aimed at reaching a final agreement within 60 days to end this conflict now in its fourth month. In a joint statement that was released by Qatari and Pakistani mediators, what we saw here were lots of really optimistic words. Positive and constructive were the words that both sides used here. Both sides also agreeing to establish a whole range of things, including a high-level committee to oversee the process, alongside working groups that are focused on the nuclear file, focused on sanctions, and also compliance monitoring as well. I think if you're following the energy markets this morning, the most significant development was this agreement to establish a communication channel to ensure safe passage for commercial shipping through the Strait of Hormuz. Iran's foreign ministry said negotiations also agreed on a mechanism to guarantee transit, although the details of that mechanism remain unclear at this point. Of course, the primary concern in the energy markets right now is what type of control or leverage that the Iranians might have over Hormuz moving forward. Whether or not that includes tolls, also a big question mark at this point. It certainly seems as if the US would be reluctant to agree to something like that. But of course, the Iranians continue to suggest that that is something that they would want. So we are watching that very closely. It also comes following Iran's declaration on Saturday that the strait was closed amid these Israeli strikes in Lebanon. And of course, this is really important as well. I've spoken with analysts, not just over the weekend, but also early this morning on the air, who have suggested that perhaps Israel is the biggest wildcard here. If we saw the Israelis keeping up their strikes inside Lebanon, then that could present perhaps the biggest risk to the peace negotiations so far. And on the Strait of Hormuz, well, the Energy Secretary also weighed in at the weekend as well. Here's Chris Wright speaking on Fox News Sunday.
In the last 24 hours, or yesterday, 67 ships went through the Strait of Hormuz. The day before, it was 55 ships. So, and in terms of oil and oil products, about equal to where we were before the conflict. So, yeah, traffic is flowing through the straits quite nicely. Now, that's because of a U.S. military presence. Iranians still have not demined the central shipping channel, but the U.S. opened a separate channel down south, And we've been escorting ships through that for several weeks now, and at very high levels today.
Chris Wright speaking earlier. And what is also interesting was the tone coming into this first round of talks as well. It's interesting because despite the breakthrough, it would also seem as if tensions remain quite high here between the US and Iran. There's been a lot made of the posturing that both sides were making inside the room over the course of the weekend, at least some of the posturing that was caught on camera. And then, of course, there is also what has been said publicly here as well. The Vice President, J.D. Vance, describing this as an historic summit. President Trump also warning on Sunday that the US could resume strikes if Iran failed to rein in Hezbollah, and also suggested that Washington could very well take over the Strait of Hormuz and charge tolls there if negotiations collapse. So, as I mentioned, it seems as if the talks, the negotiations, still very live at this point. Whether or not this is going to eventuate into a broader peace agreement remains to be seen. What we do know is that these technical talks are set to continue through the course of this week, and that is, of course, at least one optimistic sign coming out of this, an agreement to keep agreeing. It's back over to you.
As ever, superb. Thank you. I hope you're getting some... Dan, here's a question all our viewers want to know. Are you getting some rest in between all this? Because this has been so intense for you for such a long time. Genuinely.
Yeah, I'll rest when it's all over, Steve.
Oh, don't say that. I love CNBC, but it's not worth not resting, okay? All right, you get some rest, also, my friend.
And what happens if it doesn't end anytime soon? I mean, then I'll be worried.
Do you know what? I'll speak to the boss. I'll come over and cover you for just a couple of... Not as well as you, but just I'm worried about you. You need some R&R, my friend. All right, brilliant. Thank you. John Deal, Managing Director of Capital Markets, post-Oak Group. Oh, you had a good weekend. You weren't having to sit there in the Middle East, I guess. Where are you, actually? I don't even know where you are.
Good morning. I'm in Pittsburgh, Pennsylvania.
Oh, my goodness me. Well, for start, thank you for hosting the World Cup. It's brilliant. Secondly, tell us about the oil price and where you think it's going next, sir.
Great. Yeah, oil prices. Everything's about oil prices right now. I think it's... we're glad that things are moving down. I think that most likely they're going to stay approximately where they're at for the duration of the summer. So it seems like the risk premium that's, drove prices up here during this conflict is sort of evaporated at this point. But, summertime is the strongest demand season in the United States for oil prices. And, with the World Cup here in the United States, airline travel is up. And airline, as you know, is also a major source of demand for oil prices. But I'm anticipating things roughly staying the same throughout the summertime here.
John, can I ask you about what we know so far? 32 ships made the passage Friday, 26 on Saturday through the Strait of Hormuz. Hopes that, if this opening happens and we see the free flow of traffic through the Strait of Hormuz, then some normality resumes. What do you think on that front in terms of the time frame for normalization?
Well, any progress is good progress right now. I think the data point to watch is going to be daily transits. But, it's interesting to me that the timing is coinciding with the summer demand season here. So the next 60 days, the timeline here for our talks with Iran sort of coincides with that season. It's going to take some time to even out. And I think that given that the talks will coincide with our busy season, I wouldn't expect things to move around. I think that people, the immediate kind of emergency risk premium is sort of evaporated at this point, as I said, but I wouldn't anticipate too much movement from here. I don't think that prices are going to fall much more. I think that people are going to be holding their breath. We're going to be counting, looking for that daily transit number to see what progress we're making, if any. But I think it's going to be touch and go. I mean, just given the news in the last 48 hours, it looks like this is going to be a bit of a nail biter.
Yeah, indeed. We don't know whether we're going forward or back on any given day around progress on the conflict. But if there is a breakthrough here and the signing or formal signing, it felt like we had an electronic signing, which gave the impression we were done, but obviously not. When it comes to Iran, though, and the sort of reserves, oil reserves we could see coming out of that region, how significant could it be if that was the ultimate outcome?
Yeah, that's a great question. I mean, the simple answer is that Iran transits roughly 20% of the global oil supply. So theoretically, if they come fully back online, then that could be as much as 20%. I think the question that I have, and the reason why I'm not optimistic that the numbers will normalize quickly, is that the nature of this conflict has sort of prevented us from really getting a good sense of what the damage is to physical infrastructure. So no one's going to get a good sense of what kind of damage we have until the conflict is fully stopped. You simply can't assess these facilities until there's no more risk of rockets and drones and other physical risks of those types. So it will take until this conflict stops for us to get a good sense of what that looks like. Once we know how much damage there is, then we'll know how long it will take to fix it and then normalize traffic from there. But there's a hurdle that we have to go through before we can really get to back to normal operating. A normal operating situation.
Hey, John, I'm just on the AAA price at the moment, $3.93.80. That's a buck higher than we were before the war started. No prospect at all of the president getting what he wants before November then?
I guess we'll see. The president has a way of trying to get what he wants, so I can't comment on that. But yeah, it's not been pretty.
Okay, John, I'll comment. The president said we're going to have plentiful, cheap gasoline across the United States, cheap diesel and what have you, but we're still $1 higher than we were before this war started. It's inconceivable, isn't it, that in the short term and certainly before the midterms, that gasoline prices, diesel prices are going to go down to those kind of levels. And if they do, is that the end of drill, baby, drill?
The end? Oh, I don't think so. No, it's a good comment. I mean, I don't think there's any chance that prices are going to drop quickly. Okay, like I said, there's too many other factors here. But rig counts and drilling in North America has been fairly steady. It hasn't really responded as quickly as some analysts have suggested that it would. So I don't think it's the end of drill, baby, drill. But we'll see. I think the question that I have is whether North American consumers get used to these prices by November. If they get used to them, then we'll see what their behavior is in the elections this year. But yeah, I don't foresee any major changes to the North American drilling prerogative.
John, can I get to some of the winners that you see on the back of any particularly positive outcome here? There's a whole bunch of them, and they've been very bumpy over the course of the last couple of months. What do you make of some of the sectors? Just flesh out the sectors and what sort of upside you could expect.
What sort of upside? Yeah, sure. That's a great question. So, I mean, obviously, gas prices have been, massively disruptive for transportation, right? So it's affecting everything from shipping, certainly airlines, but also logistics. I think the biggest downstream effect that I'm kind of monitoring is just shipping and logistics, which flows then down into, consumer spending. So I think it's really, energy kind of underpins the entire economy in such a way that it touches everything. The topic that I'm most concerned about is agriculture and how this is going to affect the harvest season this year and the cost of fertilizer. So some of the damage in the Middle East here is really, has the potential to affect global fertilizer costs in an outsized manner. So my biggest concern right now really is fertilizer and the effect on this year's agricultural production.
Noted. John, thank you so much for joining us this morning. We do appreciate your time. Thank you so much for weighing in. John Deal with us, Managing Director of Capital Markets, Post Oak Group. Going to take you to markets. There's been a ton of movement across on the Asian boards. Japan, take a look at this. We saw it rally to an all-time high last week, up about 8%. Another 1,000+ points added to the trade today. Keep in mind this index was 51K when it started out this year, now above 72,000 points. So incredible run high. A lot of this thanks to the AI trade. The other one worth noting, of course, is the South Korean market. It surged 11% last week. Semiconductor stocks in focus, and SK Hynix now overtaking picking Samsung Electronics today to become South Korea's most valuable listed company. So incredible change of fortunes for that company. Elsewhere across the region, you've got decent ranges on the Shanghai Composite, up 1%, but the Hong Kong market is drifting off. But clearly the trade around those AI stocks, again, the South Korean and Japanese stories where it's been expressed in recent trades. To what we're seeing out of the European markets and futures this morning, we were on the back foot as we closed up the Friday trade, but on the back of a higher trade over the course of the trading week. This morning, we're very much focused on the UK. Reports circling everywhere that Sir Keir Starmer is considering his political future. We have cameras trained on number 10 this morning for developments and closely watching all forms of assets across the UK, from the stock market, the FTSE 100 to the mid-cap, to what we're seeing on gilts and, of course, on sterling. So that is a huge focus on this side of the world. Not much movement on DAX futures at this stage, perched fairly flat. And US futures, as we gear up for the trade, don't forget the market's out of action Friday. It was closed. We're looking for a resumption to the upside on the Nasdaq, although with slightly smaller ranges this morning on all of the market boards there. Coming up on the show, pressure mounts on UK Prime Minister Sir Keir Starmer, with speculation swirling that he could step down as soon as today. We'll have more next. Plus, fuel shortages in occupied Crimea. Ukraine targets yet another oil depot, causing petrol stations to halt sales. And the US says it's open. Iran says it's closed. We'll discuss the Strait of Hormuz and the outlook for oil with Rystad Energy's head of geopolitical analysis, Jorgen Leon. That is coming up at 9:45 London time.
I'm Steve Sedgwick from CNBC, and in my new podcast, Executive Decisions, I ask powerful leaders about their decisions that changed everything.
I'm not frightened of making tough decisions, and I think leadership can be very lonely.
Business leaders should not stay quiet in a world which is super complex.
It is absolutely fine to also change your mind.
Tough calls, personal crossroads. These are the stories that we can all learn from. It's Executive Decisions from CNBC. Get it wherever you get your podcasts. Speculation is mounting that Sir Keir Starmer will step down as UK Prime Minister, with multiple news outlets reporting that an announcement could come today. His position has been under increasing pressure for months, with Labour sliding in opinion polls. Starmer's position has come under further scrutiny after Andy Burnham convincingly won a by-election to return to Parliament, with a majority of Labour MPs set to back his candidacy as leader of the party. Now, the US President Donald Trump has already called it on his Truth Social. He said Sir Keir Starmer will resign as Prime Minister, claiming the PM failed badly on immigration and energy. Several cabinet ministers have reportedly advised Starmer to set out a timetable to leave Downing Street, including the Foreign Secretary Yvette Cooper and Energy Secretary Ed Miliband. Whittaker spoke to Tim Martin, the founder and chair at JD Wetherspoon, ahead of the Makerfield by-election. By the way, this is a staunch Brexiteer who's talking here, so you know the context, and got his take on Starmer's premiership.
Well, I'm an optimist and think that democracies veer between centre-left, centre-right, and if they go too far one way, it's self-correcting. So I don't think Keir and Rachel Reeves are the greatest economic leaders we've had, or even that they're very good at all. But I'm optimistic that even with them in charge, we can still earn a buck in the future, and the country on this democratic path will sort it all out.
And you now support Reform UK. Do you think that Reform has become a political home for, say, voters who believe that Brexit has not been fully implemented?
Well, I'm not a registered supporter of Reform. I supported no one until I was over 60, until the referendum came along. So yes, I was in favour of Brexit and parties which supported it. And Nigel Farage and his team are extremely successful politicians, have transformed the country without being in power. So I've got an open mind as to who I'll vote for, and I'll probably keep quiet about it as well.
Let's get to Lizzie Galbraith, who is senior political economist at Aberdeen. Lizzie, I thought it was quite extraordinary there that we've got comments from Tim Martin. Tim Martin, of course, who put Brexit messages on 500,000 beer mats in 2016 to try and persuade the British electorate to vote for something which, according to the Bank of England, has now cost 6% of economic size over the last 10 years. Are we still living with, and I know what I think, but more importantly, what do you think? Are we still living with the ghost of Brexit?
I think it has had long-run effects on the economy, and if you look at forecasts by independent bodies like the OBR, then they are also still reporting that there are some lagged effects there, particularly when it comes to things like the UK's trade intensity and its trade balance. There have been sort of fundamental shifts there that have seemed to coincide with that vote. And I think Tim Martin's comments are actually maybe more of an indication that the debate has somewhat moved on, not necessarily to say that the country's now supportive of, a complete flip, an immediate return to the EU. But there is now nuance to the debate and about the type of Brexit that the UK wants. Maybe that is actually slightly different now to 10 years ago, and the debate has somewhat shifted. The next government, or the next government we're likely to see, is probably going to have to acknowledge those debates on some level ahead of the next general election. So the conversation about how the UK actually deals with Brexit and how it tries to take advantage of it is still very much live. And there's clearly a lot of different interpretations to that, even by participants in that original debate.
I've heard a lot about the buses running on time in Greater Manchester, and well done, Andy Burnham, for getting that to work. No mean feat. But it's a very different kettle of fish dealing with the government on a national basis as well. And I've got to be honest, I've interviewed the man when he was in cabinet back in the day, and I've looked at all the evidence of his career since. I don't know what he's going to do that Keir Starmer couldn't do in order to galvanise the British economy. Have you got any ideas?
I mean, this is the major challenge because Burnham has been running ostensibly until now for a constituency seat rather than running for leadership. We've not really had those sort of big picture conversations. And as you said, he's going to inherit exactly the same fiscal constraints that Starmer's government has been dealing with. He's recommitted to the fiscal rules themselves. So he does have the not insubstantial challenge of setting out something that feels different to voters and feels different to politicians within the same very, very material constraints. Now, it's completely possible that, of course, a lot of Andy Burnham's popularity, he remains the most popular politician in the sort of the mainstream at the moment among voters, is because he's outside of Westminster. He represents something that is different. Obviously, in coming in, that may change. He may then sort of start polling similarly to other politicians of his seniority. So I think it could be a reflection of the fact that the public simply don't like politicians all that much, and Burnham feels different because he's in a different type of role at the moment. That may change, but you're right. The challenges that face this government in delivering the type of change that it's promising both to Labour Party MPs and to the wider electorate is very, very material, particularly in the short term.
Lizzie, it feels like it's going to take more than clever marketing to represent some sort of a growth strategy to the public. What we had seen from Starmer was a sort of tactical way of going around free trade agreements, setting up new growth corridors for the UK. It may be boring, but positive when it comes to some of the growth trajectory, one would say. What comes next? What could any future leader do that would bring growth to the UK?
Yeah, the challenge has always been that when you're talking about policies that improve the long-run growth trajectory of any country, particularly in the UK, they take a very, very long time to materialize. You're often talking about a payoff that is, 5, 10 plus years down the line. And that's very difficult for politicians that are looking for immediate payoff, particularly with a public that's very frustrated and when growth has been sluggish for quite a long period of time. So there's always a tension there between the policies that do the most good in the long run and actually the immediate political tensions that's going to be no different for the next government either. So I think there are things to do. You can do things potentially around improving your trading relationship with the EU. Not to say that you necessarily need to sort of undo Brexit in some sort of fundamental way, but removing some of the trade frictions that exist in the current relationship is something that Keir Starmer's government had begun to look at. It's very possible that a government under Andy Burnham's leadership would also be looking at things like that. There is likely to be, over the medium term, not necessarily this year, more of a debate around whether or not public sector investment needs to be intensified to try and stimulate some of these infrastructure projects that the UK needs. So I think there are going to be quite fundamental conversations, and maybe Andy Burnham is somebody that has a different perspective on those relative to Keir Starmer. But they're not quick fixes. None of this is going to materialize overnight. And certainly in the short term, I think Burnham is actually going to be more focused on gaining the confidence of markets and not moving too radically away from the current political agenda, certainly on fiscal policy that has been set out under Keir Starmer and Rachel Reeves.
Lizzie, just to that point, a lot of that conversation is about how he could maximise the upside, or any leader could maximise the upside, minimising the downside, to the point around what the gilt markets could do from here as we're perched either side of the 5% on the 10 or the 30-year. The comments that Andy Burnham made that really shocked the markets and has put some fear out there amongst any fixed income watchers was from him saying that we've got to get beyond this thing of being in hock to the bond markets, since going on to say he was misrepresented. But if he wasn't, if he doesn't manage very closely, if he does become the next leader of the country, what is the downside potential for any incoming leader to shock the bond markets?
So clearly it's there. We've seen instances in the past where leaders have come in and made very significant and crucially surprise announcements that have resulted in material market moves. Now, I don't think that we're at particularly high risk of seeing that with Burnham. As you've said, he walked back those comments. He is showing, I think, a level of awareness about some of the concerns that the market has held about prospects of his leadership before, and he's now during the Makerfield campaign, walking a much more conservative line when it comes to fiscal commitments. I think a key thing that markets are going to be watching for is who he puts in his fiscal policy team. Who is going to be the chancellor? Who are his economic advisors going to be? What kind of voices are going to be around him, and what sort of instincts have they had on these kinds of issues? That's the real indicator. So for now, the market moves over the past week or so, I think we're starting to see a market that's comfortable with an Andy Burnham that remains committed to these fiscal rules as he said he will do. I think if he starts to shift away from that in the immediate term, or starts to make policy announcements that maybe indicate a medium-term change of direction, then that's going to have to be choreographed very carefully because markets are going to be watching those types of moves very closely. So I don't think he's automatically causing kind of very significant concern, given that he's walked back some of the comments that caused the original issues with the market. Indeed. But there are still things that he's going to be watching for very closely that are going to have to be very carefully communicated going forwards.
Lizzie, you talk about who he's going to get his advice from. I've got a lot of trust in the three names that have been mentioned, the likes of Andy Haldane, formerly of the Bank of England, Jim O'Neill, Lord O'Neill, crossbencher, formerly of Goldman's, and Richard Hughes, formerly of the OBR. A lot of trust in them. But the problem is, I had a lot of trust in the advisors who were advising Rachel Reeves and the charm offensive she made before she got into power. And then straight away, she upset the entire British business establishment by upping their costs to do business, which have had extraordinary consequences for youth unemployment and for employment more generally, and the willingness of employers to take on more staff as well. Do these politicians, when they get into power, in your opinion, actually listen to those smart advisors?
I think when you are saying things in opposition or out of government, it it can often feel far simpler to say that you're going to, enact meaningful change, quick change, move the country in a different direction. It's often a lot easier to diagnose policy problems when you're not having to actually implement those changes. And then what we see with successive governments is that the scale of the challenge of actually governing becomes a material constraint, and they start having to engage in trade-offs that they probably wouldn't necessarily have chosen otherwise. And maybe it's possible that the influence of those advisors sort of starts to fade into the background slightly as they are presented with sort of the immediate challenges of needing to find fiscal headroom to offset some of the wider policy challenges in government. That's been something that we've seen across successive governments of all stripes. So I think it's partly a challenge of moving from opposition or from being outside government to moving into government and having to look at all of these issues in the round. And it's also probably a challenge of also having to think not just about taxation revenue and the impacts there, but also of the whole fiscal challenge facing the government. Many departments remain quite constrained and likely need additional revenue, not more cuts, if they are to continue to provide the same type of services that they currently do.